Today, we're going to take a closer look at CoreWeave, a company that I believe is a multi-bagger opportunity. And they did announce a massive deal with Meta Platforms. On today's episode, I want to take a closer look at everything investors need to know about this AI giant, from bullish to bearish scenarios, and obviously that Meta deal. So let's take a closer look in today's episode.
I want to thank The Motley Fool for sponsoring this video, and check out fool.com/Jose for the 10 best stocks to buy now. With that link, you get a promotional offer for the subscription service. Now, let's continue with today's episode.
Now, for those that are not familiar with CoreWeave, CoreWeave is a company that is in the AI infrastructure. They build out AI infrastructure for other companies and rent it out. Now, I might be biased here, but when it comes to pure AI infrastructure at scale, I don't believe there's any competitor in the neo cloud that can do it better than CoreWeave right now. CoreWeave is the best of the best in AI infrastructure solely. Maybe there might be other players that have other business avenues, but solely in AI infrastructure build out, CoreWeave is the best. And we can see here, they were the first to bring up the Nvidia GB300 NVL72 system compared to its competitors. And being able to bring up a new system as quickly as possible allows you to enter into long-term contracts that provide amazing ROI for your infrastructure build out. And that's something we're going to cover throughout this episode. But to me, CoreWeave is the best of the best here. Let me know if you guys have any different thoughts, and if so, why. Now, with CoreWeave, we have seen a massive growth in RPO. In their last earnings, which they reported in August of 2025, they reported roughly $30.1 billion in RPO or backlog. Now, in just the past 5 days, they've actually increased that. We've seen contracts of 20 billion north with OpenAI and Meta, and I believe by the end of Q3, we're going to hear that their backlog is actually closer to 50 billion. Now, these are just estimations because obviously some form of consumption happens between Q2 to Q3, but I believe we're going to be closer to $50 billion in backlog for this company. Now, that is insane. Nearly 75% growth on a sequential basis, yet alone on a year-over-year basis. This company has a lot of contracts, and not only a lot of contracts, long-term contracts, which I believe make it a lot different than some of the other players. Now, before I kind of share my overall thoughts on the price, we're going to look at some great charts just to see how this company reacts and how this company has acted in the past few months. Now, all these charts are made possible by fiscal.ai. Make sure to check out my promotional offer at fiscal.ai/Jose. You get 15% off. They are increasing pricing tomorrow. Today is Tuesday. So if you want to lock into legacy pricing, make sure to check it out right now and use my code to get a subscription. I use it on a daily basis, and I was using it even before I was a partner. But first, looking at the overall drawdowns. This is a company that's extremely volatile. Since its IPO, we've actually seen numerous times where the stock has dropped down over 40%, at some point even over 50%. I believe this volatility is going to stay with this company. I think the AI infrastructure market is, well, I think the long-term opportunity is there. Any small noise within the AI infrastructure space can create highly volatile movement. So be prepared if you own this for the volatility. We can see the stock is still down roughly 24% from its overall year-to-date high. Now, luckily, the stock has performed great from IPO. I mean, we can see 245% since total return since IPO. That's a 3-bagger already, right? It IPO at around $40, now sitting north of 120. Eventually gonna, and at one point it was over $160. Now, if you want to know the history of CoreWeave in my portfolio, we purchased around here in the 40s. We sold this way up, and we re-entered right here in the sub 100s in the past 2 months. It has become a very, very healthy position. The company is completely different, in my opinion, from what the public knows in forms of RPO, in forms of the contracts, like I've shown, from this price that we saw in June, where it was close to $180. I want to say I wouldn't be selling any of the movement up right now because I'm pretty excited for this stock's long-term potential. Now, I just want to kind of compare it again to some of the other players in this space. We have CoreWeave on purple, up over 240%, Nebius up roughly 269%, and Iron up over roughly 348%. Now, all of these compete a little bit. They have some overlap, but I believe when it just comes to pure AI infrastructure built out at scale with long-term contracts, no one is touching CoreWeave. So I'm excited for all you other shareholders. I'm not bearish on Iron. I do own Nebius. But when it comes to AI infrastructure built out, CoreWeave is going to be the one that dominates in this space. Now, looking at revenue estimations, we can see this is one that is expected to be a massive revenue grower. This most recent quarter, which is expected to, for this upcoming earning of Q3, analysts don't expect much growth. We only see maybe a few single digits sequential growth, but we know that CoreWeave is expected to spend a lot of money in capital expenditure at the end of this year. When they build that infrastructure, they're going to power up the system, and analysts are expecting massive revenue growth starting December 25th. I believe we might see a bit of a beat in this quarter, but nothing too crazy. It's kind of actually in line with what the guidance they gave us. They gave us roughly $1.2 to $1.3 billion in revenue. Maybe a small beat, but what I am super excited is going to be that Q4 guidance and the ramp up from there. Now, like I mentioned, RPO has continued to grow. I believe by the end of, when they report Q3 earnings, is going to be closer to $50.8 billion. Now, obviously, there's some consumption that happens between Q2 and Q3. So it might be in like the 48s, 47s, but regardless, I believe we see some massive growth here in RPO, and it's going to be closer to that 50 billion opposed to where it was just sitting a quarter ago of $30 billion. Now, I also want to take a look at this customer breakdown, right? This is, and if you're enjoying the episode, you're not going to get any information like this for free anywhere else. Make sure to hit the thumbs up and the subscribe button. Now, this is the RPO estimation breakdown. So roughly 44.1% is coming from OpenAI, mainly that $22.4 billion deal that they have. I'll talk a little bit about kind of how that works out. 14.2 is Microsoft and others. Some of those others are like Google. We heard that Google is partnering up to use some infrastructure, even though we haven't had it heard publicly just yet. And Meta is the purple at 14.2 with 28%. So this is the customer concentration is shifting. There used to be 75% one player. Now we're shifting it to being OpenAI, to being Microsoft, to being Meta. I'm actually happy about this. Now, I believe it will always be only a handful of customers that will be paying a big portion of this revenue, because they are only focusing on long-term contracts with big customers. And those are only going to be your hyperscalers. Those are going to be only your training companies. So for the foreseeable future, I believe customer concentration is going to be a handful or two handful of companies that will be making up a good portion of this sheet. Again, we're going to see your Metas, you're going to see your Microsoft. There's also, let me see. So in just the last few days, on September 5th, we saw that CoreWeave expanded their agreement with OpenAI by up to $6.5 billion, bringing it up to roughly that 22.4 that we see there. And on September 25th, they released the SEC today, but Meta has initially committed to pay the company up to $14.2 billion through December 2031, with the option to expand that commitment through 2032 for additional cloud computing. So just in the past 5 days, you've seen roughly a $20 billion growth in RPO. Now, Nvidia does have a backstop of $6.3 billion, which is not included in this RPO because that's more of a contingent insurance. This is not an incremental RPO. Some people might be wondering, Jose, didn't Nvidia just also have it? That is only if there is a lack of demand for the capacity that they have. So I did not put that in RPO. That's more of a contingency in insurance. Now, understanding CoreWeave, I think you really need to understand the power. And this is where I say, I don't think anyone is there at this level with CoreWeave of active power right now, or even by the end of the year. So CoreWeave, they mentioned they have assembled a substantial power infrastructure totaling roughly 2.2 gigawatts, expected within the next few months. By the end of 2025, CoreWeave will actually have 900 megawatts in operation. There is no one out there who has 900 megawatts in pure AI infrastructure. You might have a few that might be doing it with Bitcoin mining, but no one that has it in pure AI infrastructure. That is amazing. And then they have an incremental 1.3 gigawatts of contracted power that they can turn on depending on market demand. Now, this is a great chart. By the end of the year, active power is expected to go to roughly 900 million. Where, for if you're not familiar, right now where we're sitting at this latest earnings, the latest earnings was roughly 400 megawatts in operations, 420, I believe, or 440. But regardless, they're gonna more than double it by the end of this year, by the end of 2025. And that is a perfect example of why many analysts are expecting revenue to nearly double by March 26, right? Because if right now we're seeing around $1.2 billion, if you in theory double your AI infrastructure, you should be able to double your revenue. So that's why by March 26, you are expecting revenue to be 2x due to that capacity growth. Now, the deals that we see, in my opinion, make CoreWeave the best of the best. Long-term contracts have the best success rate on return on investment, right? This is what they're doing. Who have they announced, right? They have Microsoft long-term contracts. They have Meta to 2031. They have OpenAI for however foreseeable future. These are long-term contracts with individual players. Long-term contracts have the best ROI. There are other players that are doing short-term contracts in this neo cloud, in this kind of capacity play. And I would say be careful to see how your company is doing these types of contracts, because short-term contracts look good at first, but due to Nvidia and kind of the overall AI ecosystem innovating the chips at an annual cadence, the return of investment diminishes really quickly if you do short-term contracts. And let me give a quick example. This is the numbers aren't really truth, but it's just to explain it. Let's say you do a long-term contract. Long-term contracts are usually 4 years out. So let's say you do $4 per year. That gives you $16 at the end of the 4 years. Now, a short-term contract is when maybe you put up a system when it's due. You're able to charge $5, $6 for year one. People are going to take that. They need that product right away. So $5 year one. But then when the short-term contract ends, because Nvidia has produced a new chip and it's so much better, you have to reduce the price. And not only that, all these other neoclouds have also built more AI capacity. Because of that, that short-term contract has decreased of what you might charge for that other chip. That year two, you might charge $3, right? Year three, you might charge $2. And year four, you're going to charge $1. At the end of the day, that 4 year, you're only getting $11, where that long-term contract is $16, and you have that consistent revenue. So it is crucial for me when I'm investing in AI infrastructures to be investing in the companies that are doing the long-term contracts, especially the long-term contracts with these big AI companies. Some people see the concentration of just big companies as a risk. I see this as an asset. And again, it's mainly because of the ability that CoreWeave will have a better ROI than some of the other players. Now, the only other player that I know is doing long-term contracts with one of these cloud service providers is Nebius. Nebius recently announced that massive $17 billion with Microsoft, or 60, I forget what the number was, but was it 19? I forget, but it was some massive number, and that was Nebius with Microsoft. Now you might say, Jose, there's some other companies, TeraWolf with Google. I forget what the other ones are doing with Microsoft or some of the other players. Actually it was Google, right? TeraWolf, and I think it was Cypher Mining with TeraWolf. There's a difference in models. There's colocation models and there's cloud models. CoreWeave focuses only on cloud models where they rent out GPUs. Now, cloud models have a shorter dated contracts compared to colocation. They're about 4 to 5 years. Some might be even shorter than that. We know CoreWeave focuses more on the 4+ 5 year time frame, but they have superior payback. Usually you get about 2 years, your money back on GPUs in 2 years, and roughly 3 to 4 years, you actually get your money for the GPUs and infrastructure. So anything after that is free money. Now, this offers superior economics and faster capital return. Now, co-locations, which you might be thinking with your TeraWolf and maybe your Cypher Mining, This is longer dated contracts. You usually have 5 to 20 years. A lot lower margins, lower payback period, often higher than 7%. Very little cash flow during financing period due to the debt structure. I'm focusing more on the cloud model, but obviously, with the overall market that we're in right now, co-location companies are getting a lot of visibility. And I've even done a video covering about 15 of those. So co-locations are interesting and they definitely have a great trend right now. For my long-term investment for a company I'm willing to hold 6 figures in a portfolio, I'm looking to buy cloud models. Those are the ones I like the most. So just for those that might have missed my video maybe a month or so ago, I was mentioning that I was accumulating shares, looking to go for 15% of my portfolio. It was currently about 6%. I haven't seen where we're at right now. My portfolio on my position of CoreWeave is close to the six figures. Actually, after these returns, it's gone over the 6 figure. But average cost is around $90 right now. I was kind of buying up. I would be accumulating anything below 100. Now, for me right now, this would be like a small dollar cost averaging. I believe CoreWeave, with a market cap of what, $60 billion, still has the opportunity to be a market beater and to actually be a multi-bagger if the AI story, and I'm going to talk a little bit about that in the future, but if the AI story is as real as we're hearing, this is going to be, in my opinion, a $200 billion company within the next 5 years. That to me is great return on investment. Now, my top level long-term companies are AI compute constrained, and the AI market is still in early innings. CoreWeave helps eliminate the bottleneck of AI compute and is able to build massive AI infrastructure at scale and highly reliable. Like I mentioned, there is no one right now that I believe can do this as well as CoreWeave. The other thing that I believe is crucial is, and this is NVIDIA's favorite child, believe it or not, if you don't want to or not, it's not because of the investment they have. CoreWeave, because they are the best student and they are NVIDIA's favorite, because they know that NVIDIA knows that because they do really good at it, they're going to produce really great solutions for the AI ecosystem. So NVIDIA favors them. Anytime CoreWeave or anytime NVIDIA announces a new product, guess who's the first to say, yes, Jensen, I'll take it. I'll add it on my data center. That is going to be CoreWeave. And for that reason, those two are some of those 3 reasons, right? The overall compute constraint, early in inning in AI market, well, for early in AI innings, NVIDIA's favorite, and able to build massive infrastructure at scale, make this, in my opinion, a long-term hold. Now, this is obviously a bearish thesis for the company. I wanted to talk a little bit. And first is the massive debt. Again, all these you can find on fiscal.ai. Use fiscal.ai/Jose for 15% off. But AI infrastructure is expensive. This is one of the biggest bearish theses, right? Recently, on a recent conference, the CFO of CoreWeave mentioned that when they make any forms of debt financing structure, it's all based on long-term committed customer contracts. So it's all backed by customer contract. They're not going to be building on speculations. They're going to be building on long-term contracts, which allows them to have free cash flow back to the parent during the contract period, which I think is really well. So they're reducing the risk because they're only buying due to the demand and long-term contracts. And here they kind of showcase this slide of how they do their overall business model. Initial prepayment after they have the contract signing, then they go out there and build and buy these massive AI infrastructure. The other bearish thesis that we've heard about is customer concentration, right? We saw 71% 2025 was customer A. Many say that's Microsoft, obviously Microsoft. But like I mentioned, now we have Meta. Now we have OpenAI. I think this is going to start changing pretty soon. And it's always going to be a few amount of customers. I would say two handfuls of customers at most, but because they are looking for those long-term contracts for massive AI scales, systems and clusters, only a selected amount of customers can really contract that. Now, bullish thesis, like I mentioned, insane demand. We saw in Q2, by the end of Q2, they had roughly $30 billion in RPO. Now that I recently showed, it's closer to $50 billion based on my expectations and estimates. The other thing is CoreWeave has mentioned that customers right now are no longer talking about 100 megawatt systems. They're now talking about gigawatts at scale. Who can do things at scale? CoreWeave can. And that to me is is part of that bullish in the overall demand. Now, my bullish thesis number 2, like I mentioned earlier, was Nvidia's partnership. Nvidia recently released a networking solution called Spectrum XGX. Can you guess who was one of the first partners to start connecting with this new networking solution? You guessed it, CoreWeave. Now, I don't care about the equity position that Nvidia has on CoreWeave. CoreWeave is one of the first to adopt Nvidia solution. CoreWeave are one of the best at what they do, and Nvidia likes it. And Nvidia wants to show the other cloud service providers that there are other players out there. So the easiest way is, this is Nvidia's prime child, the perfect A+++ child that gives A+ work and does it as soon as possible, and is also the yes man. And I think as long as CoreWeave is the great at doing this, Nvidia is going to favor them. If CoreWeave ever slips up, I think Nvidia will find another poster child, but I don't see that happening right now. Nvidia wants to build out AI factories, a new style of data centers. CoreWeave is the perfect fit. Now, to me, my final thesis, like I mentioned, bullish thesis, is all based on the strength of the AI market. If what Nvidia CEO has said in the latest earnings are true, then we are truly in early innings. Now, if the AI market slows down, the heavy debt on companies like CoreWeave, that not so great balance sheet, can destroy that investment. So it's one that is a major risk. But I believe it's a multi-bagger, definitely multi-bagger from here. It's very volatile. I believe we will experience 50% drops, not at once, but over time, like we've seen in the past few months. And they're not impossible for us to see in this company. Regardless, right now, I believe it's more of a dollar cost average. For me, I have already built a massive opportunity. I have no intentions of selling. And it's for me either doing maybe selling some puts just to, if I get exercised, I build my position. But if not, I overall get some form of income as well. So my position is staying. Maybe I might be playing the options game a little bit with some form of income plays. So I hope you guys enjoyed today's episode. Take care, have a good day, and see you all next time.